Hi there, good afternoon, and welcome to this webinar on, I suppose, getting set for 2022. And let's all try to put 2021 behind us and let's go forward. So, welcome. My name's Gareth Wood from Hayward Wright. So, one of the directors here, been with the business now for over 6 years, going strong with various clients in different sectors. But I suppose one of my bits of areas that I do tend to spend a lot of my time on is working on this type of work that I'm going to go through. So the whole plan for today is to, I suppose, really run through some of the challenges that we are definitely going to see through 2022 and hopefully look forward and how we can make things better. So some of the challenges or some of the new challenges that people definitely are realizing or seeing in 2022 or partially through 2021 as well and beyond or before is the continuation of the COVID pandemic. I suppose in there and out there, we do see some challenges for obvious reasons. Some of those definitely being the labour and supply shortages, whether it's due to COVID restrictions or trying to bring people in due to Brexit, etc. And also the rising costs and inflation or inflationary costs that we've seen. Some of these can also be directly related bound to Brexit and COVID, but as expected, these are the things that are just happening in the world at the moment. Ongoing cash flow and financial issues. So people are still having a bit of a pinch. So we're just going to go through that and what we can do or how you can look after your business to make it work well for yourselves going forward, or if there are any difficult areas we can work on, and the new rules regarding trading with the EU and weak global economy, another massive challenge there that I know various clients are feeling. So as we go through this, if you have got any questions, please feel free to drop them in the questions and answers box, and as I go through, if I see any, I will try to make comments about them or answer any of the questions, or if not, somebody one way or another will be back to you, whether it's after the webinar and so forth, but I'm sure we will answer all questions. So let's try on to the next one. So the importance of financial health. So what is it really? So what makes it healthy? So in this presentation, we intend to cover some of the most obvious. So how to implement and make sure that financial health is or can be done using real-time accounting data, understanding the role of management accounts and reporting, that cash management tools and techniques, the wonderful pricing models that probably quite a few of you may be fully aware of, but we can touch base on those. And then the key performance indicators that help improve the business value, plus plan to ensure that you have an effective strategy for 2022. So implementing time accounting and real-time accounting data. So some of those, we've assisted many businesses on this area, getting people to utilize Xero mainly and other online accounting packages. But our main bread and butter is Xero. We've got many clients on it, and utilizing that to ensure that it's, I suppose, giving us the relevant information to our clients, making it nice and easy. And to be fair, I'm definitely going to go through some of the benefits in a minute. But the pandemic has really made it rather relevant to have the ability to see where you're going and what you're looking at, and empowering the business leaders to make quick and fast decisions, because obviously, as we know, things are changing quite frequently and quite rapidly in general within that business or your business or a business. And in the coming years, it can only make things more challenging if you don't take this, especially with Making Tax Digital coming through as it already has for VAT, but in the coming periods for the rest, like self-assessment, income tax payers, self-employed, and along with any landlords with gross income over 10 grand. And then in future, there will also be corporation tax to follow at a later date. So I won't go into too much detail with that, but it just gives you a bit of an idea of what will be coming. So the benefits of real-time accounting, I suppose some of them are pretty obvious. With having up-to-date and relevant information, you can straight away see a P&L rather immediately, as long as everything's been reconciled, but gives you a good idea of what the profit and loss reports are. You've got 24-hour access, so you can always get hold of the data. Nowadays, people can, well, you can get it via your mobile phone, via an iPad, on the computer, desktop, print it, look at it later. You can easily collaborate with advisors. So it's gone of the day where there used to be a Sage backup and you have to send the Sage backup back to your accountant and they would restore it. And by that point, the data can already be out of date reasonably quickly. And it became quite a challenge. So with the online system, it sort of like mitigates that. We were able to spot signs of distress and profitability or new opportunities, which I think is one area where a lot of people have really taken with it, is looking at the profitability they have done for that month, or what have they done differently last month compared to the previous months, because you can see it jump up slightly. Also using third-party apps that can automate everyday tasks, as it states. So the likes of Dext, where you just take a photo of the invoice, pulls out the relevant information to import it. Same as payments, you can do the payments on within Xero and then export a payment document to actually send to the bank, and it does the whole thing for you. But most importantly, it keeps everything accurate. It gives you an up-to-date picture of the financial health of the business, so you can have a look at balance sheets and bits and pieces. So the joys, I suppose that, well, maybe not so much the joys, the worry that some people have is like, how do you really go about implementing that new system? There's a couple of people out there that sometimes think, oh, if we're going to do a system, we need to go 100% go straight into it and have everything running immediately. No, you can do, but there's a lot of pressure by doing that. It's always best to start simple, start small. So the sooner, sometimes if it's a startup business, if you do get onto a decent software such as Xero, immediately brilliant, because you're learning from, I suppose, when it's a small little growing egg, before it becomes an absolute giant beast. And hopefully, with everything that you're able to see and search and work on, you will see that growth. But at the same time, if you're sometimes using two systems, what you can do is slowly but surely decrease what you're doing on one system as you're building up onto, say, for likes of Xero. Instead of posting your sales like you used to do, you could do it within the system and send them immediately to save time, and then slowly but surely bring more and more stuff across until you're literally just purely running on that new system. You can expand the sources of data used. So in essence, you can be looking at, I suppose, fetch is another one with Dex, I suppose, like utilizing the ability of that app to actually fetch out invoices, which you originally previously always having to type in. It's a bit of a time saving, but also an accuracy, because you're eliminating that human input. You can develop new strategies by looking at that P&L. And have a look at things, building a strong data governance and quality infrastructure, and then just, I suppose, overall with that new system, is seek advice. If you're looking at doing it, or somebody's looking at that, or literally going, I'm going to implement this new software or new system, and you don't know where to start, seek advice. We're here to help. That's what we can do. We do a lot of that. With the implementation and training, etc. We offer all those services on how to use Xero to its best of abilities, and that's what we do very well. So preparing a cash flow forecast. So most people think they're quite scary. They can be quite chunky to do, but if you've got the right software in place and the data's clean when it becomes and starts to be put into place, it makes things a lot simpler. So preparing for a cash flow forecast, management accounting reports provide vital insights into the business's performance. They really do. I cannot never stress that enough. People seem to think that just keeping the records and making sure the bank's reconciled is a true business performance, but how do you know that's true or not? If you've got a lot of invoices that have been put through and you haven't actually paid them, you could be looking at bank thinking you're doing well until all those creditors start knocking on your door. So during this challenging period, they allow you to, I suppose, monitor and distress weakness, spot areas for investment and growth, focus on profitable products and services. So if you do sell particular, like it says there, products or services, you can actually within Xero, you can put a tracking item on it, so you can actually make sure or just see which items are actually more profitable or what service is actually more profitable than others. And you can cut in necessary costs and then help assessing finance, because obviously by doing management accounts and cash flow forecasts, etc., you're able to prove the willingness of the business, where it can actually go, and actually or generally I'm actually working one at the moment, and they're looking for finance, but they want to see a P&L, a balance sheet forecast, along with a cash flow forecast, because they want to see that they can actually make all the repayments and that they've actually got the cash there to grow the business. So I'll probably touch some on this. So why are management accounting reports so important? A management accounting report gives specific insight into the operations, allow you to judge your business's performance in the next week, quarter, or year. And they typically can contain an overview of your cash flow, or at least your cash position, details of how much money is moved in and out of your business, a profit and loss for the same period. So if you're look on a monthly basis, you could look at 3 months prior, all the way up to 12, beyond if need be. But sometimes you have to manage your expectations of how much data you can look at. But generally, people try to look at 3 months to 6 months, or for that period that you're concentrating on, especially if you've done budgets and forecasting, that you can compare them. So information on assets and liabilities and the equity of your business, so to make sure that you're not trading, or that you're perfectly fine with trading and you're not trading into a loss. And detailed data about your receivables and payables, so for the given time frame. So if you have got at that date and time, how much you're due in or how much you're due out, it's handy to be able to click a button and say, well, right, you've gone in, the cash flow is X, I'm missing a particular amount of funds, I need to get some more in so I can pay these payables. Who owes me money? You can quickly get hold of it. So regular management accounts allow you to compare that financial performance and find trends that could guide the future direction of the business. So what should a report contain? So quite a few people can sometimes have a bit of a guess at this one, but in general, it's that executive summary, so just a bit of an overview. So just highlighted areas, instead of having the whole compact. I suppose it's taking the whole report and turning it into short statements. So a very brief overview, a quick P&L. So if you want to concentrate on like turnover as such, and then with a profit figure, or how you're doing compared to actual V budget, it's very handy, just very high level report. Then a cash summary, just to see where you are cash wise, what's expected to go, what's going to be coming in, and see where you'll be at the end of the month once everything comes in and out. That profit and loss report, nearly said P&L there, but yeah, profit and loss report. Obviously, balance sheet, wealth of business, and then, like I say again, age receivables, cash money that's coming into business, age payables, what you need to pay out. Then if there's any other discretionary information, so for instance, if you as a restaurant, you may have how many sets of how many covers you've had for that particular month or that particular week, or if other various KPIs that you may want to try to use there, you could just report on it. So the importance of cash management. Cash is king. But I think everybody who's gone onto any reports or any discussions in general have always been told cash is king. Doesn't matter about profit, because if you've got £1 million on that line, but nobody's paying you, you may as well have zero, and you may as well continue to be a busy fool. What you want to be doing is concentrating on that cash flow. You want it coming in, and you're going to need to understand when it comes in to when it goes out. So a well-prepared cash flow forecast can help you predict sales performance, give you that estimated cost and spend expectations, and indicate when cash will come in to and be leaving the business. And I think that areas which I just touched on, it's all about when it comes in and it goes back out again. As a minimum, a business should look to compile a 30 to 60 or 90-day cash flow, 100%. It may take you more time with also an accountancy firm, or you need to, if it's worth the cost, it's you can sleep at night knowing that you've got the funds then to continue then for the next 3 months within ease, and or if there isn't, you've got time to then alter and change what you're doing to make it happen, to make sure you're still in that positive position where you want to be. So preparing a cash flow forecast. So there's various steps, but I suppose the simple breakdown here would be sales forecast. You need to know what your sales figure is. From that point, then obviously, if you know that you make markups, etc., if you're selling products, you're able to achieve it from that point. So you're then able to pull together a profit and loss forecast. So you've done your GP, and then you can follow on with the generic costs that you always do. Actually expect all those overheads that you know that will be coming through. We can then from that estimate what includes VAT on what you've got to pay VAT on, and then use of all these elements to compile a true cash flow forecast of the business. So drawing up these forecasts needn't take too long, and then with our professional assistants, we can actually make it into a colourful report using the likes of Futurely to help you guys understand where that cash flow will be in the coming months. So, yeah, improving credit control. Now, I suppose if we was in a room, I'll probably be asking the question, everybody put your hand up if you've ever had this issue, and I'll guarantee you 90% of you guys may not want to put your hands up, but if you could, you would. So an important element of healthy cash flow is that credit control process. Many smaller businesses have historically struggled to recover payments, especially from larger clients, because sometimes the larger the client, the longer their terms, or they like to push that because they always like to throw their weight around, which I don't agree with, and it's not fair really, to be honest, because the little guy's the one that's always going to struggle. So a couple of steps in order to make this work better for you guys would be to create a review existing credit control procedures. So if there isn't any control procedures, let's look at putting something in place, such like having them on 30 days, or have a reminder emails going out, or a conversation with them. And then if it gets to 45 days, maybe look to, should they be put on stop? Do you need to speak to the client themselves to try to get something in? It's just, I suppose, and then if it gets to the point where you have to look at legal letters, it's just having that process. So, hold on, they've gone to this period of length of time, right, let's make a change. Right, what's my next step I need to do? Research into new clients, prime example, do a credit check. We can do that for you. We can have a bit of a chat and run something on those clients. Obviously a bit of a cost, but there's nothing worse than having to outlay a lot of money on something that you've had to purchase to then resell, or even your time, and then you're selling your time to find out that new client that you thought was going to be absolutely amazing, and they wanted 100 grand a year off you, or 10 grand a year, or 500 pound a year, turns out to be an absolute dud, and hasn't got anything to pay you back because their cash flow forecast wasn't done and they can't afford to pay anybody. Foster positive working relationships. So create that working relationship with that client, build on it. Be quick, be accurate, obvious one. Incentivize them to pay. So you can get to the point where you could offer them discounts if they paid faster, or just say that you're going to charge them interest if they don't. But it's all about just building that relationship, to be honest, and make the ability to make payments easier. So obviously, generally, most people go out there and say, oh yeah, just pay us buybacks. Well, that's only given them one option. If you then said, oh yeah, you could pay like debit card and credit card, so having a card machine or a DD being put in place, yes, you may lose a percentage of what your sale value was, but it's made it a lot simpler for them to pay. And at the end of the day, cash is king. So if the quicker you get the cash in, it might be going out, or it starts to build within the business. And as you build cash within the business, or wealth within the business, you can then invest that into other areas to try to help and improve it. So difficulties of pricing. So many business owners, already struggle with the difficulties of pricing. In some cases, setting prices by their competition, and in others, charging amounts. So it's all about looking at it and saying, oh, well, what can we charge? What's the best prices way to do it? And obviously in the next slide, you'll see that we're going to go for a couple of pricing models. But there's nothing to be scared of about getting it priced right, and don't always go against the competition because everything's different. All scenarios are different. So some of the pricing models that we tend to try to consider. So it's that psychological pricing. So if you're, especially on the retail side of things, I think everybody would have known or heard about it. So one thing might be the RRP was $19.99, it's now $12.99. Yeah, probably it was always going to be $12.99, or it was probably going to be a $10.99. But they thought, well, the original RRP price was $19.99. Let's see if we can get away for $12.99. We would make decent profit at that point. But it's just that perception that somebody's getting a deal at the end of the day. That's what it's all about. The importance of 9. So, or there's the importance of 9 and 7. So you say something's 10 quid, and so somebody else says it's 9.99. We know where this is going. 9.99 is cheaper than £10, and it sounds a quid cheaper. And really, it's a penny. What's a penny? And that works everywhere. You always see it for 99.99, for 119.99. You do see it, and then for the real punch in the teeth is if it's for £9.97. A whole well 2p, but it's the same thing. Relative pricing. So I think one of the best examples of this one is if you can buy something from Tesco's. So Tesco's chicken, you can get Tesco's value chicken, or you can get Tesco's finest chicken. So it's exactly the same item, but one is fancy, one's just value. So it's all about that relative side of things. Contextual pricing. So it's good example for this is the money supermarket. So if you're looking at car insurance, for instance, one price could be, this is the car insurance, this is how much it is for legal cover, this is what it is for the AA, for instance. And then the next one, it might say it'd be slightly more, but legal cover's included and the AA is included. So it's having that contextual actually right there. Then, well, if I don't need these two things, then actually that one's cheaper. Or if I do need those two things, then this one's cheaper. And it's looking at that. And then be different would be when prices are the same, say for a CD that's on Amazon. If you're looking for it or on Google, a particular CD, for instance, and they both say £9.99, you wouldn't really know which one to pick, and you probably miss it. But if one said £9.99 or one said £8.59, the majority of people would always just go straight and say £8.59, wouldn't even consider too much into it, and would just buy that CD for the reduced price because they went on there to buy something and they want to feel like they've made a deal or got a deal. And then that final other one is offer choice. So I think the simple ones here is if you're able to do a service and then it's offering a bronze, a silver, a gold, and a platinum packages. So this, if you pay bronze, you get X. If you get silver, you get X plus X, and so forth, all the way up to platinum, where you get literally everything. And it's all included within that price. But it just gives you that bit of an idea of where that's coming from. So the common thread. So all of those pricing strategies rely on the way that customers perceive pricing and highlights that it can be can be one of the determining factors in the sale of an order. This means that effectively adjusting that your price could help increase sales and improve profitability. And definitely, like we all know at the moment, cash is king. Whether you're and quite a lot more people are now actually running their own households in the same realm as a business in such, is being very, very tight on what they spend some of their cash on, because obviously with everything that's gone on, yes, it was okay for some, but also very, very hard for others, and they're just having a look at everything to see wherever they can save a penny or two, and that happens down all the way down through into business, and it's just being very careful. So definitely in today's challenging world, you need to have that right pricing strategy that adapts to the market and the needs of the customers. So KPIs, what to keep an eye on. So KPIs, so those key performance indicators, it's one of those areas that sometimes if you sit down and somebody just goes, what are your KPIs? Quite often some people will think, well, I don't know, I don't know what to put down as a KPI. And the more you probably dwell and think about it, it actually starts to come clear on what they can be. So I suppose like for accountants, I wonder why I've picked that one. And you may have like the revenue turnover, but accountants, it may not necessarily just be financial. It could be how many personal tax returns have you got left to do, very relevant. January. We haven't got too many. We're doing really well, by the way. But overall there, we could be looking at as how are we performing on getting those tax returns out? Are we getting them out well within time? Are we informing our clients about what their tax liabilities are? Are we doing these things? How do we record it? That's how we record it. And then we feed that down to the team. But in general, other businesses may just want to concentrate on like the revenue and that turnover growth, make sure they're hitting that particular percentage. Are you hitting that necessary net profit that you always wanted? Have you, I suppose, if you set a target of I'm going to make 25% gross profit, I may sell XYZ at 20%, but as long as I'm selling X LM, P and Q at 35%, I should be hitting my 25%. Am I doing it? Am I achieving that? Another one there for other KPIs is, I suppose, financial side of things is debtor days. Helps to control that cash flow yet again. Same with creditors days. Are you paying your creditors too soon? It's another indicator that you could easily. It's a simple calculation to try to find out whether you are doing it correctly and in line with your business and where you want to be taking it. And they're definitely something that everybody should really consider of what they are, and then just keep an eye on them and set the targets that where you want them to become. And that's definitely one of the main aims. So sources of income, that revenue concentration, profitability over time, and that working capital, because there's no point emptying that bank account if you know that you're going to need some value within that business to then purchase other stock, or if that big contract's going to come at you and it's going to take a lot of work. Not saying that's the best way to do business, but if you do get hold of that big contract, it's going to take work, but it's going to take you 2-3 months to get paid. Be prepared to be able to, I suppose, bankroll yourself, because at the end of the day, you're in business to make money, you're in business to survive, and it may be helping you to pay your bills. You need to make sure that working capital is there to make that happen. That wasn't, I suppose, I haven't had any questions. I don't know if anybody's got any. I'll leave it open for a little bit to try to find out what goes on there. But obviously, like I said, Hayward Wright as a whole, we're here to help our clients or to help any other businesses out there that want somebody who's more proactive and than being reactive, and help to guide them in this difficult year 2022, and where relevant, I suppose, implementing Xero as such, and with the other relevant systems to try to make the ability to see where their company is performing and where it can go and lead through. We're there for you. So always feel free to give me a call. I'm there, not quite 24/7. I'll be shot for saying that, but a decent amount of time to help out. So I've just had a question come in. I won't mention names, but cheers for telling me that's a great presentation. I am trying. Can Xero help with cash flow forecasting? It does, but to a very minimal level. It can do it. It's just a little bit on the basic side, but for not a lot more extra. We can definitely implement something such as like Futurely, but it's all about that annual or 12 months forecast. Ideally, you do 12. You can do 1 year to 5 years to 10 years, but if you can put together a bit of a forecast for 12 months, it gives us something to definitely work on. And I know that Xero has recently, well, not too recently, but there is a cash flow forecast element within it. It's just it's not the strongest, but it's there. It can be done. Yeah. Any other questions? I'll give it a few minutes just in case. You never know. But no, cheers for that question. Really appreciate it. It's nice to know that you're there as well. Cool. Just see. Feel free if anybody has got anything, however weird it may be. Cool. Okay then. No, that's always good. I don't mind that. Obviously, I must have done an all right job with the presentation. Fingers crossed. But in the meantime, I suppose, yeah, if you've got any questions, we're always here to help. Feel free to drop me an email on gareth@haywardwright.co.uk. And even if if you're already got obviously one of the client managers or directors of Hayward Wright, please just drop them a message. I'm sure they'll gladly answer any queries that you may have or any questions. So yeah, but thank you ever so much for your time today. I really appreciate it. Hope you found it useful. Excellent. Thank you.